Our next guest is raising his Q2 real GDP forecast from 1 to 2 and sees a 75% chance of a so-called soft landing. Yardeni Research President Ed Yardeni joins us this morning. Ed, it's great to have you back. Hope you had a great Fourth. You've been on fire lately talking about rolling expansions instead of rolling recessions. Can you talk about how your views have evolved in the last, say, month or two?
Yeah, well, since early last year, we've been arguing that we are in a recession. It just happens to be a rolling recession, and it's hit housing, it's hit the goods sector. I think it's now going to roll into commercial real estate. But meanwhile, some of the depressed areas of the economy are starting to show like something like a bottom and maybe even a recovery. We're seeing that in the housing industry as demand outstrips supply. We're starting to see, I think, a bottoming in the goods sector, in the manufacturing sector. Didn't see it in the PMI, but we're seeing it in the regional PMIs. So I think there's some evidence that consumers that had kind of pivoted away from goods to services may be looking for goods again. It's particularly automobiles where the sales have been surprisingly strong. So it looks like the rolling recession is evolving into a rolling expansion.
This morning, you'd take a look at whether or not there are too many bulls, looking at the bull-bear ratio. And I've never seen this before, this notion that maybe the ratio we see now is not as bearish as the inverse is bullish. Is that right?
Yeah, that's correct. We did a study looking at the S&P 500 when the bull-bear ratio was 1 or less. And that almost always has turned out to be a very good buy signal when it's below 1. And we've had that at, I think, 0.6 in October of last year. And that was one of the reasons that I called that October 12th bottom in late October. Sentiment was as bad as it was back in 2009. And surely, in my opinion, things aren't anywhere near as bad as they were back then. On the other hand, when you get these bull-bear ratios of 3 or higher, yeah, the market can continue to rally for a while, but it is sort of a caution flag that, the bulls are not alone anymore. There's a lot more bulls and a lot fewer bears. And from a sentiment perspective, contrarian perspective, it's better to be in an environment where everybody is skeptical and doesn't really believe in the bull market, the so-called wall of worry.
In terms of the wall of worry, I mean, we have increasing evidence that credit is tightening. Can you have a rolling expansion if that continues?
Well, I think it could keep the recovery from being particularly strong, but the answer is, I think, yes. I'm watching the credit numbers as you are, and everybody is, looking for signs of trouble ever since the banking crisis hit. I think the Fed responded very well to that banking crisis by setting up a liquidity facility. You know, they got a lot of experience playing whack-a-mole back in 2008, 2009, creating liquidity facilities to avert a complete disaster. And so they moved very quickly with the bank liquidity facility, and it seems to have stabilized the situation pretty well. I am watching the weekly data on bank loans, and that is looking toppy in some areas, particularly commercial real estate, but it's not taking a dive. And the C&I loans are looking toppy, but that could be because inventories are finally back in control. Meanwhile, consumer credit's an all-time record high. So I'm not seeing that credit tightness that adds up to a credit crunch.